Hello and welcome to the CPB Certification Review Training with Legacy. This training is designed to assist you in passing the CPB certification exam. This course is not designed for beginners. You should understand the billing process prior to taking this review. Hello everyone, I'm Rachel McKenty and I'm delighted to introduce myself today. I am the Director of Programs and Development with Legacy Education. We are an AAPC licensed education provider and accredited with the Better Business Bureau. With 20 years of experience in the medical billing and coding field, I bring a wealth of expertise and a unique perspective to our discussion today. I hold several certifications, including Certified Professional Coder, Certified Professional Biller, Certified Outpatient Coder, and Certified Professional Coder Instructor, all recognized by the American Academy of Professional Coders, also known as AAPC. In addition to my extensive background in billing and coding, I also worked as a medical assistant for several years prior to beginning my billing and coding journey. This experience on the front lines of patient care has provided me with a valuable perspective on the practical aspects of healthcare delivery. It has deepened my understanding of the challenges and workflows within medical practices and has enriched my approach to coding and billing by grounding it in real-world clinical experiences. Throughout my career, I've had the opportunity to work across a diverse array of specialties, including internal medicine, podiatry, obstetrics and gynecology, also known as OBGYN, urology, psychiatric, gastroenterology, genetic counseling, general surgery, and nephrology. This broad exposure has equipped me with a comprehensive understanding of the unique coding and billing requirements in each field and has refined my ability to navigate the complexity of the healthcare system. I am passionate about ensuring accuracy and compliance in medical billing and coding, and I am dedicated to supporting students and healthcare providers with the highest level of expertise. I'm excited to share my insights and experiences with you today. Let's walk through today's agenda, which covers a range of important topics related to health insurance plans. Our discussion will provide a comprehensive overview of different plan types, each with its own unique features and benefits. It is essential for medical billers to understand the differences between various health insurance plan types because this knowledge directly impacts the accuracy of billing, claim submissions, and reimbursement processes. Different health insurance plans have varying rules regarding coverage, provider networks, referrals, and out-of-pocket costs. By being familiar with these nuances, a medical biller can ensure that claims are submitted in compliance with the specific requirements of each plan, which reduces the risk of errors and denials. For example, submitting a claim for a service that was provided by an out-of-network provider under an EPO plan, which typically does not cover out-of-network care, would likely result in a denial, leading to delays in payment and potentially higher costs for patients. Moreover, understanding insurance plan types helps medical billers identify which services require pre-authorization, referrals, or additional documentation before billing. For instance, HMO plans often require referrals from a primary care physician before a patient can be seen by a specialist, whereas PPO and EPO plans may not. Failing to obtain these referrals can lead to claim denials and lost revenue for healthcare providers. Billers who understand these requirements can proactively ensure all necessary steps are taken before services are rendered, avoiding unnecessary complications in the billing cycle. Additionally, knowledge of plan types helps medical billers communicate effectively with patients regarding their financial responsibilities. Since different plans have varied structures for co-payments, deductibles, and coinsurance, it is important for billers to accurately inform patients about their out-of-pocket costs. This transparency improves patient satisfaction and trust, as patients are less likely to be surprised by unexpected bills. Ultimately, a medical biller who is well-versed in health insurance plan types can streamline the revenue cycle for healthcare providers, prevent claim rejections, and enhance the overall financial experience for the patient. Here's what we'll be diving into. First, we'll explore health maintenance organizations. These plans, also known as HMOs, are a structured network of healthcare providers and facilities, and we'll discuss how they manage care and the implications for provider choice and paperwork. Next, we'll examine preferred provider organization, PPO plans. We'll look at how PPOs offer more flexibility compared to HMO, including the ability to see specialists without referrals and the costs associated with out-of-network care. Following that, we'll discuss exclusive provider networks, EPO plans. We'll cover their network structure base and how they differ from PPOs, particularly in terms of out-of-network coverage. We'll then move on to point of service plans, also known as POS, which blend features of both HMO and PPO plans. I'll explain how POS plans coordinate care through a primary care doctor and what you need to know about seeing out-of-network providers. Finally, we'll review high-deductible health plans, also known as HDHPs, including their association with health savings accounts, HSAs. I'll provide insight on how HDHP plans work, their benefits, and how they compare to other plan types. This lesson is designed for those taking the CPB exam. Once we have discussed all the plans, we'll go over several CPB practice exam questions to confirm our understanding. I'm looking forward to a productive session, and I hope you'll find this overview helpful. Let's get started. Health Maintenance Organization plans, also known as HMOs, operate through a network of designated healthcare providers and facilities, creating a structured approach to delivering medical care. These plans are characterized by their emphasis on coordinating care through a central point, typically a primary care physician or a PCP. When enrolling in an HMO, patients generally experience limited flexibility in choosing healthcare providers. This means that to receive coverage for medical services, patients must seek care within the HMO's network. If a patient chooses to see a doctor outside of this network, they may be responsible for paying the entire bill out of pocket. One of the notable advantages of HMO plans is the reduced paperwork compared to other types of health insurance plans. The HMO model simplifies the process for patients by centralizing their care under a primary care doctor, which helps manage and streamline medical records and claims. The primary care physician plays a pivotal role in this system by overseeing the patient's overall healthcare needs, providing preventative care, and referring them to specialists when necessary. Most HMO plans require patients to obtain a referral from their PCP before they can see a specialist, ensuring that all aspects of their care are coordinated and covered under the health plan. In terms of out-of-network care, HMO plans have strict guidelines. If a patient requires services that are not available within the network, they may face substantial costs or have to pay the full amount themselves, unless it is an emergency situation. Even in emergencies, while the cost of care at out-of-network hospitals is covered at in-network rates, patients may still encounter separate billing from non-participating doctors who provide treatment during their hospital stay. Overall, HMO plans offer a structured approach to healthcare with a focus on cost management and coordinated care, but they come with limitations on the provider choice and require adherence to network restrictions. Please note the insurance card example on the slide. Most insurance cards will highlight the type of plan they are. In this case, you can see on the right upper side of the card, Boeing HMO Network. Each slide will feature an insurance card. A preferred provider organization plan, also known as a PPO, is a type of health insurance that offers flexibility in choosing healthcare providers and services. PPO plans provide coverage for a wide network of healthcare professionals, hospitals, and facilities, allowing policyholders to visit any doctor or specialist within this network without needing a referral. However, policyholders are not restricted to this network and can seek care outside of it. though at a higher cost. This feature of flexibility distinguishes PPO plans from other types, such as HMO, which typically, as we talked about, require referrals to see specialists and have a set network. One of the key advantages of PPO plans is the ability to see specialists and access healthcare services directly without requiring approval or a referral from the primary care physician. This makes PPO plans an appealing option for individuals who value autonomy in managing their healthcare and those who frequently require specialist care. Additionally, PPO plans usually have more expansive networks of doctors and hospitals, giving policyholders a broader choice for healthcare providers. However, PPO plans tend to have higher premiums and out-of-pocket costs compared to other insurance types. The plan's cost structure usually includes a deductible, which must be met before the insurance company starts covering most healthcare expenses. After reaching the deductible, policyholders typically pay a percentage of the cost, known as coinsurance, for in-network services and a higher percentage for out-of-network services. PPO plans also generally include co-payments for routine services like doctor visits. Despite the higher costs, PPO plans are popular for their flexibility, wide access to care, and reduced bureaucracy compared to more restrictive plans. In summary, PPO plans are ideal for individuals who prioritize flexibility in choosing healthcare providers and do not want the hassle of referrals or limited networks. While they may come with higher costs, they offer greater freedom in managing healthcare, which can be particularly beneficial for those with ongoing or complex medical needs. An exclusive provider organization plan, also known as an EPO, is a type of health insurance that offers a balance between the affordability of an HMO and the flexibility of a PPO. EPO plans provide coverage only when the policyholder receives care from healthcare providers, hospitals, or specialists within the plan's designated network. If a policyholder seeks care outside of this network, the plan will not cover the expenses, except in the cases of emergency medical services. This makes it essential for policyholders to be diligent in selecting in-network providers for all non-emergency medical needs. One of the advantages of EPO plans is that they generally do not require referral to see a specialist within the network. This allows for greater ease and flexibility when seeking specialized care, as policyholders can bypass the need for primary care physicians to authorize visits. This is different from HMO plans, which require a PCP to manage a patient's care and approve specialist visits. However, the trade-off for this flexibility is the EPO plans have more restrictive networks than PPO plans, so policyholders must ensure that the specialists and hospitals they prefer are included within the plan's network. EPO plans tend to have lower premiums and out-of-pocket costs compared to PPOs, making them an attractive option for individuals or families who want to manage healthcare expenses without sacrificing access to specialists. Deductibles and co-payments are typically lower with EPOs, but this cost saving comes with the caveat of limited provider choices. If a policyholder receives care from an out-of-network provider for a non-emergency, they will be responsible for 100% of the costs, which could result in significant financial burdens if they are not careful about staying within the network. EPO plans are suitable options for individuals who are comfortable managing their care with a specific network and do not frequently travel or require out-of-network care. These plans work well for people who do not need a primary care physician to coordinate their care, but still desire a structured system for accessing specialists. For those who prioritize cost savings and do not mind the restrictions of staying in network, EPO plans offer a good compromise between affordability and access to specialized care. However, individuals with complex health needs or who require frequent visits to providers outside their local area might find the limitations of an EPO plan too restrictive. A point of service plan, or POS, is a type of health insurance that blends features from both HMO and PPO plans, offering a mix of flexibility and cost management. One of the defining aspects of a POS plan is the requirement to select a PCP. The PCP acts as a gatekeeper, coordinating the patient's care and providing referrals to specialists within the network. This is similar to how an HMO operates, where the PCP plays a central role in managing all healthcare services. However, unlike HMOs, POS plans allow policyholders to seek care from out-of-network providers, though at a higher cost. When receiving care within the POS plan's network, patients benefit from lower out-of-pocket costs, including lower copayments and coinsurance. In-network care is incentivized by the plan to encourage policyholders to use the designated network of healthcare providers, hospitals, and specialists. However, if a patient wants to see a specialist or provider outside the network, the POS plan will still provide coverage, though typically at a reduced rate. Out-of-network care under a POS plan often involves meeting a deductible and paying higher coinsurance, similar to how PPO plans work. This out-of-network option is what differentiates POS plans from HMOs, which usually do not cover any out-of-network care. One of the key advantages of a POS plan is the balance it strikes between cost and flexibility. POS plans generally have lower premiums than PPO plans, making them more affordable while still offering some of the flexibility to see out-of-network providers. At the same time, POS plans typically have more structure than a PPO due to the need for a PCP and referrals for specialist care. For those who value having a physician manage their care and don't mind working within a network, but want the option to see out-of-network doctors when necessary, POS plans provide a good middle ground. However, the added flexibility of seeing out-of-network providers can lead to higher costs for policyholders who frequently opt for care outside the network. In addition to higher out-of-pocket expenses, patients may face more paperwork and claims processing for out-of-network services. In-network care is generally more straightforward, as the insurance company handles most of the billing directly with the provider. For people who don't mind using a network for most services, but occasionally need the freedom to go outside the network, a POS plan offers a versatile option that balances cost control with access to a wider range of healthcare providers. A high-deductible health plan is a type of health insurance that features higher deductibles compared to traditional plans, meaning policyholders must pay more out of pocket before the insurance begins to cover a substantial portion of their healthcare costs. Although HDHPs come with higher deductibles, they typically offer lower monthly premiums, making them a cost-effective option for individuals or families who are generally healthy and do not anticipate frequent medical care. The higher deductible structure means that policyholders pay the full cost of most services, including doctor visits, hospital stays, and prescriptions, until they meet the deductible. Once the deductible is reached, the plan starts covering a larger portion of the costs, but policyholders still have to pay coinsurance or copayments until they hit the plan's out-of-pocket maximum. One significant advantage of HDHPs is their eligibility for pairing with a health savings account. An HSA is a tax-advantaged savings account that allows individuals to set aside pre-tax money for qualified medical expenses, such as those incurred before reaching the deductible. Contributions to an HSA can reduce taxable income, and the funds in the account can be used to pay for out-of-pocket costs, like doctor's visits, prescriptions, and medical procedures. Additionally, HSA funds roll over from year to year, enabling policyholders to build savings for future healthcare expenses. HSAs are particularly beneficial for those who are healthy and prefer lower monthly premiums while saving for potential medical costs. It is important to note that under the Affordable Care Act, or Obamacare, Most health insurance plans, including HDHPs, are required to cover preventative services at 100% without cost sharing. This means that services such as annual checkups, vaccines, and screenings are provided without requiring policyholders to pay out-of-pocket costs before the deductible is met. This requirement helps ensure that individuals have access to essential preventative care, which can help maintain health and detect potential issues early. It also helps policyholders maintain their overall health without additional costs. While HDHPs offer lower premiums and the benefit of HSA eligibility, they may result in higher out-of-pocket expenses for those who require frequent medical care or have a chronic condition. The high-deductible structure encourages careful financial planning and cost-conscious decision regarding healthcare. For individuals who are healthy and do not expect frequent medical needs, an HDHP can be a cost-effective option that provides financial protection against major medical expenses and allows for tax-advantaged savings through an HSA. To recap, HMO plans require members to use a network of designated doctors and hospitals. Policyholders must choose a primary care physician who oversees and coordinates their care, including providing referrals to specialists. While HMO plans generally offer lower premiums and out-of-pocket costs, they have limited flexibility as out-of-network care is not covered except in emergencies. This structure encourages cost-saving and streamlined care management, but can be restrictive for those who prefer a wider choice of providers. PPO plans offer greater flexibility compared to HMOs. Members can see any healthcare provider, whether in-network or out-of-network, though costs are lower when using in-network providers. PPO plans do not require a primary care physician or referrals to see specialists, providing more autonomy in managing healthcare. However, this increased flexibility comes with higher premiums and potentially higher out-of-pocket costs for out-of-network care. POS plans blend elements of both HMO and PPO plans. Members must select a PCP who coordinates their care and provides referrals to specialists, similar to an HMO. However, POS plans allow for out-of-network care, although at a higher cost. This hybrid approach provides a balance between lower premiums and the option to see out-of-network providers when necessary, offering some flexibility while maintaining a structured network for cost management. EPO plans restrict coverage to a specific network of providers and do not cover out-of-network services except in emergencies. EPO plans do not require referrals to see specialists and generally do not mandate a primary care physician, offering more freedom within the network. They usually have lower premiums and out-of-pocket costs compared to PPO plans, but the lack of out-of-network coverage can be a limitation for those needing more extensive provider choices. HDHP are characterized by higher deductibles and lower monthly premiums. These plans require members to pay a significant amount out of pocket before the insurance starts covering costs, but they are often paired with an HSA, which allows for tax-advantaged savings for medical expenses. HDHPs offer 100% coverage for preventative services and even before the deductible is met, aligning with broader ACA requirements. While they provide financial protection against major expenses and encourage savings through an HSA, they may result in higher overall costs for individuals who need frequent medical care. Let's move on to some practice questions. What is an insurance plan that provides a gatekeeper to manage the patient's health care? Let's review our choices. A PPO does not require a PCP and can self-refer to specialists within the PPO network. An HMO plan is characterized by their emphasis on coordinating care through a central point, typically a primary care physician, also known as a gatekeeper. An IPO, which is short for Individual Practice Organization, is not a health insurance plan, but rather a group of independent physicians or small practices that come together to negotiate with insurance companies or health plans. Since this is not a health insurance plan, we can eliminate this answer. Medicaid varies by state in its scope and coverage, and therefore would not be considered in this context. The answer is B. A gatekeeper or PCP is provided to manage the patient's healthcare needs. Which option is not considered an MCO? Let's define MCO. Managed care organizations are not insurance plans themselves, but rather they are entities that administer and manage various types of health insurance plans. An MCO provides a structured system for delivering healthcare services and often works with different types of insurance plans such as HMOs, PPOs, POS, and EPOs. The MCO's role involves coordinating care, managing provider networks, and implementing cost control measures. Essentially, the MCOs manage the care and services provided under various health insurance plans, focusing on improving quality and efficiency, while the actual insurance coverage is offered through the specific plans they administer. A health savings account and a managed care organization serve distinct functions within the healthcare system, which is why they are not directly connected. An HSA is a tax-advantaged savings account designed for individuals with HDHPs to save money for out-of-pocket medical expenses. It allows users to contribute pre-tax dollars that can be used for costs such as deductibles and co-payments, promoting financial planning for healthcare. In contrast, an MCO is a type of health insurance organization that focuses on managing and coordinating care through a network of providers to improve quality and cost control. MCOs work with various health insurance plans, as we discussed, HMOs, PPOs, and EPOs, but are not specifically linked to HDHPs or HSAs. The specific role of HSAs and MCOs reflect their different objectives. HSAs are about saving and managing costs related to high deductibles, while MCOs are about coordinating care and managing expenses through provider networks. Let's go on to the answer. MCOs include EPOs, HMOs, which we've already discussed. They also include integrated delivery systems known as IDSs, preferred provider organization, and triple option plans. IDSs and triple option plans were not talked about in our lecture, but I will briefly describe them here. IDSs are healthcare networks designed to coordinate and streamline care across various providers and services. They aim to improve the quality of care and reduce costs by integrating services within a cohesive network of primary care physicians, specialists, and hospitals. IDSs facilitate the sharing of patient information, ensuring continuity of care, and reducing redundant procedures. By working together, providers manage patient care more effectively, from routine visits to complex treatments, often using a value-based payment program model to incentivize high quality care and cost efficiency. Triple option plans provide members with three types of health insurance coverage, such as HMO, PPO, and sometimes POS plans, allowing for flexibility and personalized choices. However, these plans are not widely available as single type plans. They are typically offered by large employers or specific insurers and can vary by region and insurance provider. Availability may be limited due to regional regulations and market conditions. So, which option is not considered an MCO? That would be HSA. When a patient is enrolled in an HMO, which options below are the responsibility of the PCP? Well, let's think about this. Upon joining an HMO, a member chooses a PCP. This provider, sometimes known as the gatekeeper, is responsible for providing a broad range of routine services. Their duty is to manage the member's treatment, as they are responsible for the member's healthcare decisions and referrals to other facilities, for example, inpatient admissions. in-network specialists, or out-of-network specialists when necessary. Most plans require the referral, or the member is responsible for the cost of treatment. Each covered member of a family may choose a different PCP. A PCP is usually a family or general medicine provider, an internal medicine provider, or a pediatrician. Let's see. Our choices here are: what is the primary responsibility of the primary care physician? Manage the member's treatment, be the only provider for all the patient's health care, provide referrals to specialists, approve emergency department visits, or provide referrals for inpatient admissions. Let's take a look at the answer. HMOs do cover emergency services, thus eliminating choice 4. In an HMO plan, while members are generally required to use network providers for non-emergency care and obtain referrals from the PCP to see a specialist, emergency services are an important exception. HMOs typically provide coverage for emergency care regardless whether the service is provided in or out of network. This ensures that members can receive necessary care in urgent situations without facing additional financial burdens, adhering to the requirement that emergency services must be covered to address unexpected or urgent healthcare needs. In this case, the answer is D, because HMOs do not require the PCP to be the only provider for all of the patient's healthcare needs. Question 4. To employees, a health savings account is what? A, tax-free income, B, taxed income, C, a monthly contribution only made by employers, or D, only for medical coverage excluding dental and vision expenses. The main benefit of the HSA is its tax advantages. HSAs allow individuals with high-deductible health plans to save money on a tax-free basis for qualified medical expenses. Contributions to an HSA are tax-deductible, reducing taxable income for the year in which the contributions were made. Additionally, the funds in the account grow tax-free, and withdrawals for qualified medical expenses are also tax-free. This combination of tax benefits helps individuals save money on healthcare costs and provides a financial cushion for out-of-pocket expenses, including deductibles, co-payments, and other eligible healthcare costs. Furthermore, unlike flexible spending accounts, also known as FSAs, HSA funds roll over from year to year, allowing individuals to build a savings balance over time. Let's move on to the answer. The answer is A. As we discussed, HSA is tax-free income to the employees. They accumulate tax-free and are not taxed when withdrawn for eligible medical expenses, including for dental and vision. Contributions may be made by the employee, the employer, family member, or any other person on behalf of an eligible individual. Don't confuse HSA plans with HRA plans. Health Savings Account, HSAs, and Health Reimbursement Arrangements, HRAs, are not the same thing, although they both help manage healthcare costs. An HSA is an individual-owned account that is linked to HDHPs. The account holder or the employer can make contributions to the HSA, which are tax-deductible, and the funds grow tax-free. Withdrawals for qualifying medical expenses are also tax-free, and the account is portable, meaning it stays with the individual even if they change jobs or health plans. In contrast, an HRA is employer-funded and controlled. Employers allocate funds to an HRA to reimburse employees for qualified medical expenses, but employees cannot contribute to the account. The funds in the HRA are not portable and typically remain with the employer if the employee leaves the company. While HSAs offer the benefit of tax-deductible contributions and portability, HRAs provide employer-funded reimbursement without employee contribution, and the reimbursement is tax-free to the employee. Question 5. A patient needs to see a specialist for a cardiac condition. She references her health insurance handbook for a list of network providers that belong to that specialty. She may choose any physicians she wishes and does not need a referral from her internist to see the specialist. If she chooses an out-of-network physician, she will have to pay a higher coinsurance amount to see them. What type of insurance does this patient have? HMO, PPO, Medicare, or Medicaid? The answer is B. A PPO is a type of insurance plan that allows members to choose the doctors and hospitals they want to visit from providers within the network, known as preferred providers. If they choose not to see a preferred provider, the services are still covered, but the patient will pay more out-of-pocket costs as the services provided by the non-participating provider are reimbursed at a lower rate. An HMO requires a gatekeeper or PCP and referrals to see a specialist. Thank you for joining us for this review. Stay tuned for future reviews of Medicare and Medicaid and medical necessity involving MACs, LCDs, and NCDs. If you would like more details about our intensive CPB training or any of our other training programs, please visit our website at medicalbillcode.com.